Question 1. What is a general ledger account? Answer. A general ledger account is an account or record used to sort and store balance sheet and income statement transactions. Examples of general ledger accounts include the asset accounts such as cash, accounts receivable, inventory, investments, land, and equipment. Examples of the general ledger liability accounts include notes payable, accounts payable, accrued expenses payable, and customer deposits. Examples of income statement accounts found in the general ledger include sales, service fee revenues, salaries expense, rent expense, advertising expense, interest expense, and loss on disposal of assets. Some general ledger accounts are summary records which are referred to as control accounts. The detail that supports each of the control accounts will be found outside of the general ledger in what is known as a subsidiary ledger. For example, accounts receivable could be a control account in the general ledger, and there will be a subsidiary ledger which contains each customer's credit activity. The general ledger accounts inventory, equipment, and accounts payable could also be control accounts, and for each there will be a subsidiary ledger containing the supporting detail. Question 2. What is the difference between accounts payable and accounts receivable? Answer. Accounts payable are amounts a company owes because it purchased goods or services on credit from a supplier or vendor. Accounts receivable are amounts a company has a right to collect because it sold goods or services on credit to a customer. Accounts payable are liabilities. Accounts receivable are assets. Let's assume that company A sells merchandise to company B on credit. Perhaps the invoice states that the amount is due in 30 days. Company A will record a sale and will also record an account receivable. Company B will record the purchase, perhaps as inventory, and will also record an account payable. Question 3. What is the difference between wages and salary? Answer. You should be aware that some people use the terms wages and salary interchangeably. I and many others make the following distinction. Wages is best associated with employee compensation based on the number of hours worked multiplied by an hourly rate of pay. For example, an employee working in an assembly plant might work 40 hours during the work week. If the person's hourly rate of pay is $15, the employee will receive a paycheck showing gross wages of $600, 40x $15. If the employee had worked only 30 hours during that week, her or his paycheck will show gross wages of $450, 30x $15. Because the paycheck needs to be computed based on the actual hours worked, the employee earning wages will likely receive her or his paycheck 5 days after the work period. Salary is best associated with employee compensation quoted on an annual basis. For example, the manager of the assembly plan might earn a salary of $120,000 per year. If the salaried manager is paid semi-monthly, perhaps on the 15th and last day of each month, her or his paycheck will show gross salary of $5,000 for the half month. Since the salary is the same amount for each pay period, the salaried employee's paycheck will likely cover the work period through the date of the paycheck. Question 4. What is the significance of FOB shipping point and FOB destination? Answer. Accountants report a merchandiser's and a manufacturer's revenues when a sale is made. The term FOB shipping point indicates that the sale occurred at the shipping point at the seller's shipping dock. FOB destination indicates that the sale will occur when it arrives at the destination at the buyer's receiving dock. Accountants also assume that the cost of transporting the goods corresponds to these terms. If the sale occurred at the shipping point, seller's shipping dock, then the buyer should take responsibility for the cost of transporting the goods. The buyer will record this cost as freight in or transportation in if the sale doesn't occur until the goods reach the destination. Terms are FOB destination, then the seller should be responsible for transporting the goods until they reach the buyer's unloading dock. The seller will record the transportation cost as freight out, transportation out, or delivery expense. Question 5. What are accruals? Answer. Accruals are adjustments for 1. Revenues that have been earned but are not yet recorded in the accounts, and 2. Expenses that have been incurred but are not yet recorded in the accounts. The accruals need to be added via adjusting entries so that the financial statements report these amounts. An example of an accrual for revenue involves your electric utility company. The utility used coal and many employees in December to generate electricity that customers received in December. However, the utility doesn't bill the electric customers for the December electricity until the meters are read in January. To have the proper amounts on the utility's financial statements, there needs to be an adjusting entry to increase revenues that were earned in December and the receivables that the utility has a right to as of December 31st. Accrued expenses are expenses that have occurred but are not yet recorded through the normal processing of transactions. Since these expenses are not yet in the accountant's general ledger, they will not appear on the financial statements unless an adjusting entry is entered prior to the preparation of the financial statements. Here is an example. A company borrowed $200,000 on December 1st. The agreement requires that the $200,000 be repaid on February 28th along with $6,000 of interest for the 3 months of December through February. As of December 31st, the company will not have an invoice or payment for the interest that the company is incurring. The reason is that all of the interest will be due on February 28th. Without an adjusting entry to accrue the interest expense that the company has incurred in December, the company's financial statements as of December 31st will not be reporting the $2,000 of interest, 1/3 of the $6,000 that the company has incurred in December. In order for the financial statements to be correct on the accrual basis of accounting, the accountant needs to record an adjusting entry dated as of December 31st. The adjusting entry will consist of a debit of $2,000 to interest expense, an income statement account, and a credit of $2,000 to interest payable, a balance sheet account. Question 6. What is the cost of sales? Answer. Cost of sales is the caption commonly used on a manufacturer's or retailer's income statement instead of the caption cost of goods sold or cost of products sold. The cost of sales for a manufacturer is the cost of finished goods in its beginning inventory plus the cost of goods manufactured minus the cost of finished goods in ending inventory. The cost of sales for a retailer is the cost of merchandise in its beginning inventory plus the net cost of merchandise purchased minus the cost of merchandise in its ending inventory. The cost of sales does not include selling expenses or general and administrative expenses, which are commonly referred to as SG&A. Question 7. What is the difference between product costs and period costs? Answer. A manufacturer's product costs are the direct materials, direct labor, and manufacturing overhead used in making its products. Manufacturing overhead is also referred to as factory overhead. Indirect manufacturing costs and burden the product costs of direct materials, direct labor, and manufacturing overhead are also inventoriable costs since these are the necessary costs of manufacturing the products. Period costs are not a necessary part of the manufacturing process. As a result, period costs cannot be assigned to the products or to the cost of inventory. The period costs are usually associated with the selling function of the business or its general administration. The period costs are reported as expenses in the accounting period in which they 1. Best match with revenues, 2. when they expire, or 3. in the current accounting period. In addition to the selling and general administrative expenses, most interest expense is a period expense. Question 8. What is petty cash? Answer. Petty cash is a small amount of cash on hand that is used for paying small amounts owed, rather than writing a check. Petty cash is also referred to as a petty cash fund. The person responsible for the petty cash is known as the petty cash custodian. Some examples for using petty cash include the following: paying the postal carrier the 17 cents due on a letter being delivered, reimbursing an employee $9 for supplies purchased, or paying $14 for bakery goods delivered for a company's early morning meeting. The amount in a petty cash fund will vary by organization. For some, $50 is adequate. For others, the amount in the petty cash fund will need to be $200. When the cash in the petty cash fund is low, the petty cash custodian requests a check to be cashed in order to replenish the cash that has been paid out. Question 9. What is the cost of goods sold? Answer. The cost of goods sold is the cost of the merchandise that a retailer, distributor, or manufacturer has sold. The cost of goods sold is reported on the income statement and can be considered as an expense of the accounting period. By matching the cost of the goods sold with the revenues from the goods sold, the matching principle of accounting is achieved. The sales revenues minus the cost of goods sold is gross profit. Cost of goods sold is calculated in one of two ways. One second way is to adjust the cost of the goods purchased or manufactured by the change in inventory of finished goods. For example, if 1000 units were purchased or manufactured but inventory increased by 100 units, then the cost of 900 units will be the cost of goods sold. If 1000 units were purchased but the inventory decreased by 100 units, then the cost of 1100 units will be the cost of goods sold. The second way to calculate the cost of goods sold is to use the following costs. Beginning inventory plus the cost of goods purchased or manufactured equals cost of goods available ending inventory. When costs change during the accounting period, a cost flow will have to be assumed. Cost flow assumptions include FIFO, LIFO, and average. Question 10. What is the difference between a general ledger and a general journal? Answer. Journals are referred to as books of original entry. Accounting entries are recorded in a journal in order by date. A company might use special journals, sales, purchases, cash disbursements, cash receipts, or its accounting software will generate entries for routine transactions. But there will always be a general journal in which to record non-routine transactions such as depreciation, bad debts, sale of an asset, etc. In the general journal, you must enter the account to be debited and the account to be credited and the amounts. Once a transaction is recorded in the general journal, the amounts are then posted to the appropriate accounts. Accounts such as cash, accounts receivable, equipment, accumulated depreciation, accounts payable, sales, telephone expense, etc. are contained in the general ledger. To recap, the general ledger houses the company's accounts. The general journal is a place to first record an entry before it gets posted to the appropriate accounts.